And now it's time for Talking Trade with Sandy Siegel and Ken Wasylik, sponsored by Carroll University and Michael Best Strategies.
Welcome to another session of Talking Trade. I'm Ken Wasylik, Managing Director of A.M. Wasylik and Associates, an international business development company. Well, today we have a special guest, Dr. John Min. He's the Chief Economist at Monex USA. Monex USA is an international payments company specializing in foreign currencies. So, John, welcome to Talking Trade.
Thank you, sir. It's good to be here. Looking forward to it, especially my trip to Madison, Wisconsin. Never been. Although my cousin went there for 4 years, I never made it out there. And I was told that I missed a lot of things.
Well, you did. You definitely missed. And what John is referring to is that on January 14th for the Madison International Trade Association luncheon and program, John is a keynote speaker. He's going to be speaking on the economic forecast for 2025. And today I'd like to give just a snippet of what, John, you're going to cover at that luncheon on January 14th. And I know we only have a few minutes and it's a big topic. So why don't we just start with the biggest topic? Where are we as far as the U.S. economy? What's the status of the U.S. economy and maybe the world economy as of today?
Got it. I do teach at a local university, and if I put my professor's hat on, United States U.S. economy right now is performing as C plus or B minus. If you just look at objectively, independently, but in the world of foreign exchange, that's my world. It's always dollar versus another currency. It's a comparative. So compared to the rest of the world, especially against our major trading partners, we're a solid A. And the rest of the world, I have to give them C minus up to B minus. And one way I can describe it on my blue book, if I was giving you a feedback as my student, United States, exceptionalism. And it defied so many economists like me. For the last 2 years, many of my colleagues and fellow industry experts and market watchers, we've been expecting U.S. economy to enter a recession. In fact, beginning of last year, well, in fact, exactly last year at this time, we were expecting Federal Reserve to lower the interest rate 6 times. It turned out to be just maybe 3 if you just combine it all. One time it was 50 basis point cut. So that's the example of the U.S. economy is still doing very well. Unemployment rate is still at 4.2, which is compared to the past is solid A. And our growth rate is very surprising. We are growing beyond our potentials. And I know the reasons, 2 underlying reasons. It took me almost a year to realize it because I also expected recession last year. Because looking at all the economic models, you cannot bring down the inflation rate of 8.5% that we saw 18 months ago, down close to 2.6. That's where we are today. That could only happen if the unemployment rate goes up. That's the inverse relationship. And in order for the unemployment to go up so significantly, that requires contraction in the economy. So based on what we know in the past, recession was my call last year, and I had to retract it. But now I know why I missed that call. And now with adjusting our model, I think we're going to have another solid year this year.
So you realize, so what were those 1 or 2 factors that
one is something completely surprised because my dissertation topic from 25 years ago was productivity, because back then we were wondering what happened to the productivity. We're buying all these computers and PCs and laptops, but it took some time before the surge in productivity. And after that, our productivity was growing at about 0.5%. But for the past 5 quarters, and we still don't know why, it's not AI thing. AI is still maybe another 2-3 years away. Our productivity is growing at 2%. It's about 4 times higher than pre-2017, about twice as many as about a few years ago. There's a surge in productivity. At the same time, there has been a surge in U.S. population. Every single day, 11,500 Americans turn 65 right now, the baby boomers. I'm the last cohort on the baby boomer. And they retire because they qualify for Medicaid. And the birth rate has gone down to 1.66. It's below the replacement rate. So if you look at all the demographic studies, I was expecting our labor force to get smaller, less people working, less demand for our goods and services. But then we got surge in productivity, and we had a significant increase in population. And you know why? You can take a guess, right?
Yeah. Well, we'll be seeing what happens to immigration.
That's
You're parting next year with our new administration. But another hot topic besides immigration, with the new administration coming in a few days, is tariffs.
Yes.
And tariffs are always an economic impact for the country that imposes the tariffs, and then of course the countervailing, retaliatory tariff. So just kind of, can you give us an explanation of how tariffs work and what's the impact on the economy? And then of course, what's the crystal ball looking like based on the rhetoric today for 2025?
I think you're going to find me very, very nerdy, because during the holiday break, I read 24 academic studies on tariffs, all based on the empirical data from 2018. That's when the Trump 1.0, as I call it, put a tariff on about $300 billion worth of goods coming in from China. And now we actually have a data that we can see the real effect. And it's very clear to me, reading all these peer-reviewed journals, looking at the numbers at individual product level, that when we impose a tariff, the direct cost is goes to the U.S. consumers. It's almost 1-for-1. And then there is a drop in demand, simply because obviously when the price goes up, demand goes down. So it's the U.S. consumers who's going to pay for the tariffs. And of course, the implication is, and we just found out even the Federal Reserve Board members, all 19 of them, they talked about this when they met in December 18, because we got the minutes released yesterday. They're also worried about the tariff, because there's going to be an increase in inflationary pressure. And right now, we're getting close to 2%. That is our explicit goal by the Federal Reserve. But it has been tough, the last mile, from 3 to 2, that's going to be tough. And with the tariff coming on board and possible deportation, the Fed may be forced to keep the interest rate higher for longer. And I think that's going to put a little bit of strain. But the flip side of that, in the foreign exchange world, that's good for the dollar, because since 2018, the number one driver of the value of the currency is interest rate differential. And right now, all the trillions of dollars they're slushing around, they're looking for a place to get the highest yield, just like you want to get a highest yield on your CD. The money is pouring into the United States in terms of buying bonds and treasuries, investment, and a lot of folks buying Magnificent Seven stocks. So there's a huge demand for dollar. And that's why dollar has been very, very strong this year and last year, year before. And again, from a Monex, our research department, we expect dollar to continue to be very strong. So it might be a good time to go to Europe this summer.
Well, definitely is a good time to go to Europe. I was just in Europe twice, or no, 3 times last year. And I remember we were in Switzerland, which is one of the more expensive countries in Europe. And we're like, hey, we could spend a couple extra days on the same amount of dollars that we could a couple of years ago. But specifically on a strong dollar, that's always a negative for exports, for U.S. exports, and a positive on the import side.
And that explains the very high trade deficit numbers we're seeing. In fact, I think we'll have record trade deficit when you aggregate all the numbers. And in fact, my area of concern is that in anticipation of potential tariffs, other countries may try to devalue their currencies. Like, I kind of see that China is already doing that. The renminbi is 7.2, 7.3. We think it's going to go to 7.5. That's to counter potential tariffs. So that's going to make the dollar even stronger, hurting U.S. exporters and encouraging more imports to come in.
So, it's widely known that China manages their currency, RMB, and I've been in China 30 years ago, and that's what they did back then when it wasn't even a free-floating currency. Is other countries do the same thing? Manage their currency? Do other countries manage their currency as, like the Chinese do?
No, China has a strict ban on their currency. And they try to manage it against a basket of goods, but obviously US dollar is the main one, and they control that by default. Hong Kong dollar is also managed. Other than that, most of the developed countries, the developed trading partners, is free floating. And in fact, we have seen that if you don't have appetite to go across the pond because a flight is so expensive, you may want to think about going to Canada. Canadian dollar is at 20-year low against US dollar. And the Mexican peso took a big hit since the Trump's reelection with the tariffs and everything else. So it's good to hold US dollars. And if you hold US dollar assets, that's fantastic. That also explains why so much foreigners are investing in it.
Okay. Well, in the limited time that we have, and I know this is a big question, and you kind of alluded to it. So how do you see 2025 for the U.S.
Very
economy?
optimistic.
And what about the rest of the world?
Very pessimistic.
Okay.
I am very optimistic with the U.S. for a surge in productivity. Hope it will be sustained because as a student of productivity, it comes in waves with the technical shifts. But I think we may be the front part of the way. Perhaps AI will take over. That means companies' earnings going to be good. We're expecting another 12, 13% earnings growth this year, just like last year. That means the stock price is going to be very robust. So I think we're going to get the wealth effect, strong dollar. If you're an American dollar holder, that's going to be great. The population deportation is the only area I'm concerned about because demographically, we will begin to slow like Japan has been, and China is also experiencing that. But that's more long-term. But for this year, I'm very optimistic we will grow. Oh, by the way, we looked at about 18 different economic forecasts from different banks and how, because we're a consumer of these forecasts. The most comfortable one is from Goldman Sachs, and they expect the U.S. economy to grow 2.5% real terms this year. A little faster first half, a little slower in the second half based on the tariffs. I mean, big assumption is tariff is unknown, but 2.5% is structurally built in. I personally feel that we have a chance for 2.7, 2.8, assuming the tariff is not as comprehensive as what we've been hearing so far. The Europe is, they're hurting badly. Already Germany is right at the border of contraction. And this morning we got the word that the UK is struggling because their deficit is getting very high. Japan has huge demographic issues. They had to devalue the currency. And the one I'm really worried about is China. Their leading economist, the one I follow closely, he says, no, they're not growing at 5%. That's the government headline. The real growth rate is about 2.5%. So the rest of the world seems to be slowing down, which means they're going to be lowering their interest rate. U.S. is going to be a standalone, robust economy with a higher interest rate. That's really good for the dollar. So that's going to put additional pressure on trade deficit. I think we will have ongoing trade deficit. Maybe that's the knee-jerk reaction by the incoming Trump administration. They're trying to reverse that. But
yeah, in 30 seconds, you haven't mentioned AI. Is that going to be an impact on the economies?
Yes, I've been reading on various studies at the micro firm level and Boston Consulting Group, McKinsey, different organizations. AI adoption is going to be much faster than the PC or the internet adoption that we have seen in the past. And I am a little worried right now. They're positioning it as an assistant to the labor. So it's not going to replace human labor. But this morning, we got a survey from leading banks. They think they can do 200,000 less employees in the next 2 years because of AI. In our firm, we're thinking about using AI for business development efforts. Instead of hiring a cohort of the analysts every year, we're actually testing 3 or 4 different AI agents. So I think it's going to be transformative. I'm not a stock advisor or anything else at all, but just to let you know, I got big eggs in AI invest companies.
Okay.
Including NVIDIA.
Okay, well, that sounds good. So, John, we're out of time on this session of Talking Trade, but all of you You can hear more, and I know, John, you have a cohort that's going to join you on January 14th. That's with the Madison International Trade Association program. It's going to be at the Fluno Center. I believe it starts at 11 o'clock. It's a luncheon program. I believe the registration is still open for that, and I'm looking forward to hearing all your remarks at that session on the 14th. So thank you, John, for joining us on Talking Trade.
Thank you very much, sir. Looking forward to meeting everyone on Tuesday.
And I'm Ken Wasylik, Managing Director of EM Wasylik and Associates. We'll see you next time on Talking Trade.
You've been listening to Talking Trade with Sandy Siegel and Ken Wasylik, sponsored by Carroll University and Michael Best Strategies.